Hi everybody, it's Professor Olney back again. This time I'm going to make you a little video on how to draw the graphs associated with a market coming to a long-run competitive equilibrium. The thing that you want to keep in mind is that we're looking at perfect competition, so we're in an industry in which there are lots and lots of firms, each producing a homogeneous product, in an industry in which there are no barriers to entry and no barriers to exit. That means that if there are abnormal profits in that industry, other people can start new businesses in the same industry, producing the same product. They can enter that industry because there are no barriers. And remember from the first part of the course that if there's a change in the number of firms that are producing and selling a product, we're going to show that as a shift of the supply curve in the market. Keep that in mind. The other thing to remember is there are no barriers to exit, which means that if the firms are incurring losses, that firms can leave the industry. The firms that leave the industry means that we're going to have a shift in our supply curve. What I'm going to show you is the response of a market, a perfectly competitive market, to three different events. The first is going to be an increase in demand, and we'll see how firms enter the market in response to that increase in demand. The second is going to be an increase in input costs, and we'll see how that drives up prices and leads firms to leave the industry. And the third is going to be an increase in fixed costs. So we're going to do all three of those. Here we go. Get yourselves ready. I'm going to draw some pictures on the whiteboard, and I think we're ready. Every one of these pictures is going to have two graphs side by side. So you want to start with two sets of axes that are side by side. On the left-hand side, I'm going to draw the picture for the market, and on the right-hand side, I'm going to draw the picture for a typical firm. So on the left, on the market, I've got the price of the product on the vertical axis and the market quantity on the horizontal axis. On the right-hand picture, in the typical firm, I'm going to measure a whole bunch of things on the vertical axis. I'm going to measure marginal cost, I'm going to measure marginal revenue, I'm going to measure average total cost, I'm going to measure the price. All of those things are denominated in dollars. And so I just write dollars as my label on the vertical axis. I could write, if I wanted, marginal cost, marginal revenue, average total cost, price. That's a lot of labels to put on one axis, and so the standard is to simply put the dollars there and not write all those other things down that are also measured on that axis. On the horizontal axis for the typical firm, I'm measuring the quantity that's produced by the typical firm. This is the only time when I really care whether I'm using an uppercase or a lowercase q. I use the uppercase q for the market and the lowercase q for the firm as a way of reminding myself that these horizontal axes are really different scales. So the quantity in the market might be measured in, say, tens of thousands, while the quantity for the typical firm might be measured in hundreds. Remember, in a perfectly competitive market, there are lots and lots and lots of firms, each of which is such a small part of the market that what they do doesn't really impact the market. What their individual behavior is doesn't impact the market. So I think thinking about the market as being measured in tens of thousands and the firm being measured in hundreds probably does a good job of capturing that difference between the market and the firm. Okay, so let's start. Draw ourselves a downward sloping demand curve, D1, upward sloping supply curve, S1. Find the equilibrium price in that market, label it P1, drop it down, label the equilibrium quantity in the market, Q1. I'm going to take that price over to the picture on the right, which is for the typical firm, and mark that price P1 on the right. Remember, for the typical firm in a perfectly competitive market, that typical firm faces a perfectly horizontal marginal revenue curve at that price P1. The typical firm in any market has an upward sloping marginal cost curve. It has that initial little Nike swoop, Nike swoosh part where it's a downward sloping initially before the diminishing marginal returns kick in, but over the vast range of quantities for the firm, we have increasing marginal costs because of the practice of diminishing marginal returns. The profit maximizing quantity for this firm is to produce a quantity Q1, where marginal cost equals marginal revenue. That's the quantity at which this firm will maximize profit. In order to know how much profit this firm is earning, we need to have an average total cost curve. I want to start with the long-run competitive equilibrium, which means I'm starting with the typical firm incurring zero economic profit. Remember that zero economic profit doesn't mean they're not making any money. It means that the amount of accounting profit that they are earning is exactly equal to the opportunity cost. They could not do any better in any other industry. So I'm going to start by drawing an average total cost curve that comes down, hits its minimum where it crosses the marginal cost curve. That's always true. The average total cost always hits its minimum where it crosses marginal cost. And because I'm starting at the long run competitive equilibrium, I'm starting with that average total cost at quantity Q1 also equal to the price P1. So I'm starting in a position in which this typical firm starts with zero profit, zero economic profit. Okay, there's my setup. So now let's look at the impact of an increase in demand. Short run, first effect is something happens, it doesn't really matter, you can figure out income, wealth, prices of related goods, what else do we have? Expectations, and one other, preferences, something, one of those things, doesn't matter. It takes and shifts the demand curve to the right. So we're going to have a new demand curve D2. At the old price P1, the quantity demanded in the market is now greater than the quantity supplied. That puts upward pressure on the price. The price is going to rise until it reaches the price P2, where the demand curve D2 intersects our original market supply curve S1. That means the typical firm in this market now faces a new higher marginal revenue curve at that price P2. So I dashed over the P2 and I draw my new marginal revenue curve for the typical firm, MR2. This typical firm is now going to produce a higher quantity where the marginal revenue 2 curve crosses their marginal cost curve. Let me dash that down. And that gives me quantity Q2, which is the new quantity produced by the typical firm. That's perfectly wonderfully consistent with the fact that the market quantity has increased from Q1 to Q2 because each of these firms in the industry is now producing a greater quantity in order to maximize their profit because they're all charging a new higher price, P2. What is the profit? Well, to figure out the profit, we start from the quantity Q2 and we go back up until we find the average total cost curve. And that tells us the average, I'm going to run out of space here. Let me put my label up here. That's the average total costs of producing the quantity Q2. The price that the firm is receiving is price P2. We know that profit is the total revenue minus the total costs, which is the same as the quantity times the price minus the average total costs. Ooh, ooh, ooh. That should look like the formula for the area of a rectangle. Indeedy. So what we have is a rectangle, the base of which is the quantity Q2, the height of which is the difference between the price, P2, and the average total cost of producing that quantity, Q2. So we're going to calculate the area of this rectangle between the price and the average total cost at quantity Q2, and the area of that rectangle is equal to the profit that's enjoyed by the typical firm. This is a perfectly competitive industry. In a perfectly competitive industry, if there's a firm that is incurring and enjoying economic profit, their profit is greater than zero, there are other people who look at that industry and say, whoa, dude, look at the profit they're making over there. They're making money hand over fist. I could do that. Anybody could do that. It's a perfectly competitive industry. There's no barriers to entry or exit. It's not like there's some sort of special knowledge that the people have that enables them to produce this good. Anybody can enter the industry. How hard is it to enter this industry? Not hard at all. And so others wanting to make profit see that the typical firm in this industry is making profit, and so firms enter. So what we're going to have is new firms are going to enter the industry in order to chase those profits. They want some of those profits too. Well, what do we know? We know that when there are more firms in an industry, that takes and shifts the supply curve to the right. So the long run effect, this is a long run change. The number of firms can change in the long run, but not in the short run. The long run effect is for the supply curve to shift to the right. The supply curve is going to shift to the right, and as the supply curve shifts to the right, we're going to be moving down this second demand curve in terms of price. The price is going to start to fall as there are more firms producing the good in the industry. If the price falls to someplace between P1 and P2, you can play with it. I'm not going to mess up my drawing and draw it here. If the price falls to something between P1 and P2, your typical firm is still going to be earning economic profit. And so firms will continue to enter the industry, and they'll continue to enter the industry until the price is driven all the way back down to, draw a nice big dot so it looks like these lined up, until the price is driven all the way back down to the original price P1. So my third price, which I'll call P3, is going to be the original price P1, which means that for the typical firm, the marginal revenue curve, I'll call it MR3, has shifted back down to the original marginal revenue curve, which means that the quantity that this firm will produce in order to maximize profit is going to be back down to Q3, which means that, voila, once again, when they produce Q3, which equal to Q1, the total costs, the average total cost of producing that quantity are exactly equal to the price. And in the long run, we're going to have profit equal to 0. Notice that the market quantity has gone up to Q3, even though the firm's quantity has gone back down to its original. How does that work? How can the market quantity go up when the typical firm is back producing what they were producing initially? That's right, there's more firms. There's more firms. So the typical firm is producing its original quantity, but because there are more firms, the total market quantity, which is the quantity of each firm plus the other firm plus the other firm, so it's the aggregation of all the quantities of these typical firms. That typical firm is producing the same quantity it was before. There are more firms, and therefore the market quantity, the aggregation, has increased. All right, that's the first one, and that shows the effect of a change in demand. Second, now we're going to do another example, and this example, there we go. This example is going to look at the effect of an increase in input costs. So once again, I want to start from the same position. I want to start from the long-run competitive equilibrium and then see how this event affects what we do. So 2 graphs. The market graph is going to be on the left, and the typical firm graph is going to be on the right. Price on the vertical, market quantity on the horizontal for the market graph, bunches of stuff measured in dollars on the vertical, quantity for the typical firm on the firm graph on the horizontal axis, downward sloping demand curve D1, upward sloping supply curve S1, original market equilibrium price P1, original market quantity Q1. Take that price P1, dash it over to the right, mark off price P1, and for the typical firm, that's going to be their marginal revenue, MR1. Throw a marginal cost curve on there, MC1. Find the profit maximizing quantity, Q1, and then because we're starting at the long run competitive equilibrium, you want to draw an initial average total cost curve, ATC1, that hits its minimum just where the MC and the MR curves intersect. So we have in the long run, initially the typical firm is earning 0 economic profit. All right, now our event. The event in this case is going to be an increase in input costs. Could be an increase in materials, it could be an increase in labor. I don't really care, it doesn't really matter. It's going to be an increase in costs. First thing I'm going to do is show the effect on the firm side. So first I want to show you the effect on the firm side. I guess that's this way from your perspective. I'm going to show you the effect on the firm side. The increase in input costs means there is a higher marginal cost associated with producing each quantity. So if labor is going to be paid $15 an hour instead of $12 an hour, that's going to increase the cost of producing each and every quantity that's being produced. My marginal cost curve is going to shift up. MC2. And not only does the marginal cost curve shift up, but my average total cost curve is going to shift up as well. The minimum is still going to be at the old quantity, the same quantity as before. So the average total cost curve shifts up, the marginal cost curve shifts up. Those things are trying to shift up by about the same amount. And so we've got this shift up of ATC and the shift up of the marginal cost curve. All right, what does that mean? I haven't shown you the market yet. I'll get there. for the typical firm in the industry is now going to produce the quantity where marginal revenue equals marginal cost. So the typical firm in the industry is going to produce at the intersection of MR1, because the marginal revenue hasn't changed, and the marginal cost curve, and that's quantity Q2. Which means that at the original price, P1, because I haven't changed the price yet, at the original price, P1, the typical firm in the industry is now producing a lower quantity, Q2 instead of Q1. Now come back over to your market graph. What is that telling you? It tells you that at that price, P1, the typical firm is now producing a lower quantity, and so the market quantity is also going down at that original price, P1. And so I'm going to have a new supply curve, S2, that's to the left of the original supply curve. That's why back in chapter 4 we said when there's an increase in input costs, it takes and shifts the supply curve to the left. What we've just done is demonstrated why that's true. We've demonstrated that when the marginal costs rise as a result of the increase in input costs, the typical firm at the existing price P1 will, in order to maximize profit, want to produce a smaller quantity Q2. So this shift from S1 to S2, that's due to the increase in costs. So the increase in input costs what is it going to do? It's going to shift. It shifted the marginal cost curve. It shifted the average total cost curve. Because it changed the quantity, the profit maximizing quantity for the firm, it also shifted the supply curve. We're not done by a long shot. So the first thing that we want to see is that the market price isn't going to stay at P1. That increase in input costs is leading these firms to want to pass that increase in input costs on to their customers to the extent that they can. And because this is happening in all of the firms, there's going to be upward pressure on the price. The price is going to rise to price P2, where the second supply curve intersects the first demand curve. Trace that back over to price P2. So now I'm going to draw, this is getting messy, huh? I'm drawing a second marginal revenue curve, MR2, that's consistent with the second price P2. And so now, what's this firm going to do? This firm is going to produce a quantity. What am I going to call it? I'm going to dash down here, and I'm going to call this quantity Q3 for the firm. This firm is going to produce a quantity Q3 at which the new higher marginal cost curve intersects the new higher marginal revenue curve. Okay, no problem. That's also what we see on the left, right, in the market graph, is that the market is going to settle at a quantity Q3 that's in between the original market quantity Q1 and the second market quantity Q2. Cool. Everything's good. Except the typical firm, they're producing this quantity Q3, that's their profit maximizing quantity, but the average total costs of producing quantity Q3, so the average total costs at Q3, the average total cost of producing quantity Q3 is above the price. So this area here, bounded by the price P2 and the average total cost of producing that quantity Q3, that's a reflection of their loss. They have costs above price. The typical firm is incurring a loss. They're unhappy. The typical firm is incurring a loss, and so in the long run, what's the typical firm going to do? If they're incurring a loss in the long run, in the short run they have to figure out whether to shut down or produce. We're not going to go there right now. In the long run, what are they going to do? Right, they're going to exit the industry. So some of these firms, not all of them, some of these firms are going to start to exit the industry. As firms exit the industry, shift back over to your market picture. As firms exit the industry, there are fewer firms producing this product, which means that our supply curve is going to shift to the left a second time. So we're going to have a second shift in the supply curve. As the supply curve shifts to the left, the price is going to rise. If the price doesn't rise sufficiently to cover the increase, to cover the total costs, the same thing's going to happen again. So firms are going to continue to leave this industry until the price rises. And how high does the price need to rise? Go back over here to your firm picture. The price has to rise until the marginal revenue curve comes along here and intersects the marginal cost curve at that minimum of the average total cost curve. So my third price, where this market's going to settle by the time it's done, that price P3, which is where I'm going to get when the supply curve shifts to S3, and this is due to firms exiting the industry. That price P3, dash it over here, which determines my marginal revenue curve, MR3. That price P3 is going to mean that the typical firm that remains in the industry is going to be producing a quantity where marginal revenue equals marginal cost. What's that quantity? Dash it down. Looky there. That quantity, I'm up to Q4. Quantity Q4, the new long-run profit maximizing quantity for the typical firm that remained in the industry. Bunches have exited, they're gone. Some of them didn't exit yet, they're still there. Those firms that remain in the industry go back to producing their original quantity, so quantity Q4 equals quantity Q1. But the market quantity has fallen, actually, looky there, the market quantity has fallen down to, indeed, I think that's right, that the market quantity has fallen down to that Q2 that I marked initially. I'll just make big dots there so you can see it. The market quantity falls further because there are fewer firms. So the typical firm is back producing its original quantity. The market quantity has gone from Q1 down to Q4. The market quantity is smaller because even though the firms are producing their original quantity, Q1 equals Q4, little q1 equals little q4, the number of firms in the industry is less. And so a smaller quantity of firms times the same quantity, little q4, equals a smaller market quantity. Ooh, do you see what had happened here? In the long run, the total increase in input costs, got passed on to the buyers. The price rose from price P1 to P3. That increase from P1 to P3 completely covered the increase in input costs. In the long run, firms exit the industry. And what consumers find is that consumers wind up bearing 100% of that increase in cost. So think about if that increase in cost had not been an increase in wages, what if I'd said, I want you to show me the short run and the long run effects of, say, an excise tax? That's what we're shown here. What we showed here was not just the short run effect of the excise tax, that's the red line, the S2 lines, the MC2, all the red lines. We're showing the long run effect. The long run effect is that firms exit the industry, and when firms exit the industry, the buyer winds up bearing 100% of the burden of the tax. The whole input cost in the long run, once firms have exited the industry, is borne by the buyer. Kind of interesting, I think. All right, we got one more. So that was an increase in input costs. The increase in input costs, it's pretty complicated. You wind up with 3 supply curves, a lot of shifts going on, but the bottom line is the increased costs get passed on to the buyers as a result of firms exiting the industry. Last one I want to do is to look and see what's the effect of an increase in fixed cost. All right, once again, let's start with our standard setup. So we're going to have the market here on the left and the typical firm here on the right. Price on the vertical, market quantity on the horizontal on the left, bunches of stuff measured in dollars on the vertical, typical firm quantity on the horizontal for the picture of the firm. Start with an initial downward sloping demand curve, D1, initial upward sloping supply curve, S1. Find your initial equilibrium price, P1, dash it over, mark P1, that tells you the marginal revenue for the typical firm in the industry. Throw a marginal cost curve on there, MC1. The typical firm in this industry is producing a profit maximizing quantity little q1. The market as a whole is producing a quantity uppercase q1. The typical firm, we're starting in long run competitive equilibrium, so the typical firm has an average total cost curve equal to ATC1, which finds its minimum right where marginal cost and marginal revenue intersect. Voila, long run competitive equilibrium, the typical firm in the industry is earning zero economic profit. Now, what's our event? Our event this time is suppose there's an increase in fixed costs. Suppose there's an increase in fixed costs. If there's an increase in fixed costs, remember that your marginal cost curve is telling you about changes in variable costs. Change in variable costs for a change in quantity. So a change in fixed costs has no impact on the marginal cost curve. Nothing happens there. What does happen when there's an increase in fixed costs is the average total cost curve shifts up. Remember, it's still going to hit its minimum where it crosses the marginal cost curve, but the average total cost curve has shifted up as a result of that increase in fixed costs. I should probably have drawn that so that the change in, actually let me erase it. I'm fine with making an eraser here. They say you should edit out the video to not show mistakes, but I think this is a good mistake to show you and to fix. If the fixed costs increase, so there's an additional $100,000 in insurance policy that's the dollars of which are independent of how much is being produced. Since the average total cost is the total cost divided by the quantity, the impact of that increase in fixed cost is going to be much greater at low quantities than it is at high quantities. So I really should have drawn my, whoops, erase. I really should have, I know I can do an eraser. There. I really should have, large. Oh, there. Well, there. Ta-da! What I really should have done, that's a lot of work, wasn't it? What I really should have done is I should have shifted my average total cost curve so that it's a big increase initially and it gets smaller and smaller. But it's still, everything else I said is still fine. That it's going to shift up, it's going to hit its minimum where it crosses the marginal cost curve. All that's good. Oh, except now what happens? Now what happens is at that quantity Q1, there's now a higher average total cost. So the average total cost at quantity Q1 is now much greater, which means that this firm that previously had been incurring zero economic profit now is incurring losses. So the area of this rectangle below the average total costs and above the price with a base equal to the profit maximizing quantity Q1, the area of that rectangle, I probably should have shaded it red instead of green because the area of that rectangle are losses. Ooh, unhappy firms. Those firms are now, the typical firm is now incurring losses. What we know is that when firms incur losses, that some of those firms are going to exit the industry in the long run. So the first thing we're going to see on the supply side of this is that the firms are going to start to exit the industry. So we're going to have a second supply curve, S2, and that second supply curve is a result of firms exiting the industry. As firms exit the industry, there's a smaller market quantity available for sale. That puts upward pressure on the price. The price is going to rise to a price P2. Firms will continue exiting the industry. Let me change my color so that I'm having fun. The firms are going to continue exiting the industry until the price rises. Did I do it? Ha ha ha. I'm so clever. Until the price rises to the point where the new marginal revenue curve, there we go, ta-da, until the new marginal revenue curve, MR2, which is at the price P2, just crosses the marginal cost curve at the point where the new higher average total cost curve is hitting its minimum. So now this typical firm is going to be producing a quantity Q2. Let me put that in blue just because it's fun to do that. The typical firm is now going to be producing a quantity Q2. The market quantity has gone down. How does that work? Why is the market quantity down, but the firm quantity is up? Right, there's fewer firms. So the number of firms is less because a lot of firms left the industry because of the increase in fixed costs. So those losses led to exits. And because there are fewer firms, even though each firm that remains is producing a higher quantity, there's such a loss of firms that the market quantity has gone down. So the market quantity goes down because there are fewer firms. Those firms that remain are producing a higher quantity than they were before, charging a higher price, P2, and that's the end of the story. All right, that was 3 different pictures. That took quite a little while, but I hope that was helpful to you. 3 different pictures that showed you the effect in the long run, first of an increase in demand, second of an increase in input costs, variable costs, and third of an increase in fixed costs. You can play with the same thing. Instead of having an increase in demand, play with it and see what happens if you have a decrease in demand. Play with it, see what happens if you have a decrease in variable costs. Play with it, see what happens if you have a decrease in fixed costs. All right, y'all, have a great day.